Why can't I exit full screen? And let everybody in. Go.
Smile.
Hi guys, people all over joining us.
There we go.
Is everybody muted as well there, Julie?
They should be. They came in, always a couple of people have unmuted themselves.
Quick bit of housekeeping, guys. If you could keep yourselves muted, that'd be very much appreciated. Otherwise, we'll get background noise from over 100 people that are joining the webinar at the moment. Thanks. There is a chat button at the bottom of your screen as well. So if you want to ask questions, I'm sorry, I'm stealing your thunder here, Julie, while you're
not even in charge anymore.
I know. What do you expect?
It's my show.
Yeah, it's your show, but M&M have taken over. No, there's a chat button down there. That's what I was going to say. Go on, carry on, Julie. Go for it.
Sure, honestly. Do you mind?
Go on, then.
But you've done it all for me, what I was going to say. There's still quite a few more people joining. So what I'll do is just quickly go through how the evening is going to go. So anyone that hasn't joined us before on the meetings, it's very laid back way of doing things. Also, there's a no sell policy. So when you're asking questions or when the people are presenting, it's all about information and not about hard sell. What I will do is just give a very quick, brief legal update for coronavirus and any new acts running the way through Parliament. And then I will pass over to Mark and Mark, who, interestingly, I named on my calendar today as my evening with M&M. But anyway, that was a whole different topic. So there's just a few more people joining. So basically, I will just quickly go through the legal updates. I'm going to try and share my screen. I haven't been very technical today, so bear with me as this all goes horribly wrong, I'm sure. Yeah, it's not letting me. I should have made you admin, Mark, and you could have let everyone in as I was trying to do everything else. It's not letting me share my screen for some reason. So anyway, what I'm just going to go over very quickly is obviously we all are very aware that in the next few weeks we have got the electrical 5-year tests coming in. That will be the 1st of July. And that will be for all new tenancies that come into the private rented sector. Landlords will need to have a 5-year electrical test on those properties, and then you will need to do it for all existing properties from the 1st of April next year. And it's the first type of legislation that we haven't had a full year where we've been able to have the adjustment period. So that's been quite an odd bit of legislation. Obviously, we all know that we've got the tenant fee ban obviously coming into force for all existing tenancies as of the 1st of June. So any clauses that you've got in your current tenancy agreements that relate to fees, they will now be sort of null and void. You won't be able to rely on them anymore when you've trying to use them for exiting tenants or changing tenancy agreements. The other one bit of legislation that I just wanted to go over, which currently is just a bill going through Parliament, and that's basically a protection of assured tenants. It hasn't really got a lot of legs at the moment, and it's interesting to look at. It's going to basically look at making the ground 8 of section 8 and section 21, they're going to demote them and make them discretionary grounds as opposed to mandatory. So it's going to be really interesting watching that one go through court, go through Parliament, sorry. At the moment, it's still in its stage of consultation, so we don't know if it's going to happen or when it's going to happen. So I will keep my eye on that, as I always do for you, and as soon as I've got a bit of an update, I will obviously keep you guys up to date with that. But it was just really interesting to see that pass through a few of the channels, the Parliament channels on that earlier this week. So what I'm going to do now, as I think pretty much everybody is in, I'm going to pass over to Eminem, and that's never going to leave me now. I've written that in my diary. So if I can ask Mark Alexander, first of all, to just give a quick introduction to yourself, and obviously please tell us all about that logo behind you of Property 118 TV.
Okay, excellent. I'll come on to Property 118 TV in a little while. Thanks for the invite and to talk to your group. It's been long overdue, so it's about time we did it. And thanks also for saying let's do this from the heart, not the chart, because I get bored of doing boring PowerPoint presentations. I'm sure people get bored of watching them. And I know we agreed to do this Jonathan Ross style, but I've already heard you say the letter R several times. So you're going to have to practice on that a little bit more, Julie. So background to me, landlord since 1989, working in the areas of property, finance, tax and law for many more years than that. So I first became an accidental landlord, really started buying more aggressively when I'd actually started to make a bit of a name for myself in the commercial finance sector. So that was kind of 1996 onwards. I set up a commercial finance brokerage in 1990. Prior to that, I was working in commercial lending and insurance at Citicorp, which at the time was the biggest bank in the world. By 1996, as I say, I'd made a decent amount of money to be able to start putting money away and investing into property. I didn't see it as a career at that time. For me, it was a way to park money for my retirement. So that's how my portfolio got built. So it's very different to somebody who might be building a portfolio today, because I wasn't interested at that time in earning an income. It was just about parking money in what I saw as a safe haven. And in later years, it's become very much more a retirement fund. And the plan always was to allow capital appreciation to have its effect, allow inflation to have its effect on my property portfolio, so that it did become cash flowing in later years. And of course it has done. My LTVs have dropped from where I started. I started sort of 70% because that's all you could get in those days. I borrowed 85% when you could in the good old days of the early 2000s, of course, and built the portfolio that way. But obviously gearing has dropped. The inflation has worked its magic on rental incomes, as it does. So I'm now in a position where I can afford to retire, or at least semi-retire, based on the income that I've got from properties. I did rather well in one of my businesses. My claim to fame, or one of my claims to fame, was that in 2008, one of my businesses ranked as number 38 in the Sunday Times Profit Track 100. That was a business that I'd literally took from sort of started off as a partnership, became a LLP limited company, and eventually became a PLC. Had 300 brokers. It was turning over, getting on for 30 million a year. It was valued at 40 million a year. We turned down an offer of 17 million for it in 2008, which was the worst mistake I ever made in my life, because a year later we had the credit crunch and the value dropped to crazy numbers. It was close to nothing. We lost 1.8 million that year after making an EBITDA of 7.5 million the year before. So life has been very much a roller coaster for me. I've had that massive up and down. A business that's making £7.5 million a year of profit, the flying around in the private helicopters and the fleet of 7 supercars and all of that sort of thing, to thinking, oh my goodness, the world has ended, and having to dismantle a business. It still exists. The business still exists. It's still got £3 million on the balance sheet, but it hasn't traded now for 10 years. But in that time, I've taken on a number of non-exec directorships, one of which was non-exec chairman of Cotswold Barristers for a little while. I work very, very closely with Mark Smith at Cotswold Barristers. We hold another record between us, and perhaps I can hand over to Mark Smith for this. We hold another record between us for the largest ever representative action case in the UK, which I was the representative and Mark Smith was my barrister. Do you want to perhaps fill us in a little bit about that, Mark?
Yeah, sure. Well, Mark, you and I have known each other for about 8 years. We've been working together in the private rented sector, and we really got prominent in terms of being able to provide a good service to the private rented sector on the back of your case against the West Bromwich Mortgage Company. The West Bromwich Mortgage Company had about 6,500 tracker rate mortgages that were extant, and they were tracking along the base rate very nicely at 1.99% above base. And in 2013, Mark and a number of other people, 6,500 people in all, received a letter saying that they were going to increase the margin above base to 3.99%, which of course, base rates being what they were at that time, virtually doubled mortgage payments overnight. Now, obviously Mark on his own couldn't take on a bank, but through Property 118, we gathered together a fighting force of about, well over 200 of the affected borrowers. We put a war chest together to secure the costs into court so that the West Brom couldn't say, well, what happens if we lose? Who's going to pay our costs? We're able to secure the costs into court. We fought the case. We lost the case in the High Court. We won the case in the Court of Appeal. And as a consequence, we won back £27.5 million for the affected borrowers. Everybody who was affected, not just our action group, got their money back. They got restored to the same terms as they were before. 100% of the legal costs were paid. And there was a subtle ruling at the end, basically saying that the loans which West Brom had threatened to call in if they lost the case couldn't be called in unless there was an event of default. So you will probably know from your mortgage terms that if the mortgage lender wishes to do so, it purports to reserve to itself the right to call the loans back in. The court has said, well, if you've got a 25-year loan, you've got 25 years to pay it off unless there's some event of default. So that gave us a lot of prominence in the private rented sector, and that happened in early 2016. Everybody was delighted with that outcome for about a week, and then they said, right, well, Section 24, what are you going to do about that? What's your next trick? So Mark and I and his team at Property 118 have been working on ways in which we can help private rented sector businesses remain sustainable, remain scalable, and the most tax efficient that can be achieved. So that's really what we spent 98% of our time doing since that case.
Brilliant. Thank you, Mark. Just a quick question to the audience. Right at the bottom of your screen, there's a little button in the middle at the bottom that says chat. I'd be really interested to know where you guys are based, because I know this is an online forum and usually it's kind of Hemel Hempstead and around, but it's been promoted on Property 118. So if you could just leave a little message, just say hi and maybe where you're from in the chat box. I don't know if you guys can do that. Hi, I'm based in Hemel. Chen, near Heathrow, first time investor. Melinda, she's from Watford. Oh, they're coming in thick and fast now. Hi from St Albans from Chris, South London. AJ Kumar, Chris is from St Albans. Darren from Hertfordshire, Wesley from Bushey, Des Taylor, Windsor. Watford, Christina, Michelle, where's she from? Oh, I can't go too fast now. Jeanette from Hemel, Oxfordshire, but properties in Middlesbrough, originally from Hong Kong. Wow, another international. Any more out there want to tell me where you're from? No? Okay. A few people are a little bit shy. Oh, Slovakia originally. Hi, Christina. Manchester. Wow. I bet you don't usually get many people from Manchester, Julie.
No, absolutely not. And I wish I'd have asked this question before, actually, because that would have been quite interesting.
How about Rena, Colombia? Hello, Colombia, I should say. I always pronounce that wrong, Rena. Apologies. Ranjit Iverheat Books.
Yeah, Ranjit's put his name up twice. He's going to tell us something about it, why he's here in a little while, I guess.
All right. Okay. Excellent. Excellent. Well, that's all good news. One of the things that I've been asked to talk about is tax. I'm the head of the Property 118 tax team. I'm the founder of Property 118. To your surprise, you might be interested to know that I'm no longer a director of Property 118, nor am I a shareholder. And the reasons for that is that I'm a tax exile. So home for me, well, actually, I don't know wherever I lay my hat is my home at the moment. I've got homes in Russia because my wife's Russian, so I do speak a little bit of Russian. If Christina also speaks Russian, привет, what you приятно. So I have a home in Russia. I'm currently at my home in Florida, but my home for tax purposes for the last 4 years has been Malta. But I've just changed my tax resident status by acquiring another home in Cirta in Portugal, which is the mountains of Portugal. And that's a particularly tax efficient place for nomads like myself to actually end up as being a tax resident. Now, before we get on to that, and Julie may have some questions about tax residency, I just thought I'd talk a little bit about the worst, or usually the worst ownership structures that you can have in buy-to-let. And I suspect a lot of you still have them. Now, the two worst are usually sole owner or joint owner. And the third worst, sometimes, and you might be surprised for me to say this, is limited company. I'm going to go in reverse order and explain why limited company can be the worst. I see on Facebook all the time, if you're a high rate taxpayer, you've got to be a limited company. Not necessarily true, because if the interest rate is, let's say, 3% for a limited company for your mortgages, and it's 2% for a sole owner or joint buyer, then the difference in the tax of 20% that you might be paying between being a high rate taxpayer and their Section 24 and the amount that you're paying as a margin of interest rate over, so 3% versus 2% is 50% more, it may actually be better not to be a limited company. Now, if you're buying HMOs, even if you're a high rate taxpayer, that is, if you're buying HMOs, high cash flowing properties, and your route to market and lending is the commercial lenders like Shawbrook, Paragon, Aldermore, Handelsbanken, Coutts, etc., then what you'll probably find is that the interest rates that they're charging you for your lending are not dissimilar whether you're a limited company or an individual. So on those kinds of deals where you're buying maybe something, a flat above commercial, a block of flats, a HMO, that kind of specialist lending, then if you're a high rate taxpayer, a limited company may well be the best way to go. But so that's starting on that one. Let's talk about
Mark,
sure.
I've got a guy that's just put his hand up. So Anthony Altman, if you want to unmute yourself and ask your question to Mark.
Can you hear me?
Yeah, I can. Hi.
Right. Well, assuming not everybody is a computer programmer, how the hell do you respond to anything on this? Because I haven't got a clue.
Bottom of the screen, you've got a button that says chat. If you click on that, it'll come up with a little chat column. It'll appear a little chat on the right-hand side of your screen.
Yeah, I've done that, but I can't see, and I typed something in, but I can't find a single way of sending it.
If you go down to the very bottom, that's where you type your message in, and then
hit enter. I've just said me to everyone, hello.
Oh, right. Well, I didn't hit enter. That's probably where I did wrong. I typed it in, but I didn't hit enter.
Okay. Do you want to do that now? And I should be hi all. Is that you?
hang on, it's gone now. I can't even find the bit that says where it was typed in. But I'll try and see if that works. Has that worked at all? Enter? No. No.
Do you want to ask a question anyway, rather than just putting it in the chat?
No, well, you're just asking where you're from, and I'm from Sheffield, and I've been 48 years in the business. God help me.
Well, longer than me then. Yeah, 1989 for me, and what was it, 86 for that I entered financial services and as commercial underwriting capacity. So that's where I got the background from: property finance, tax, and law, of course. Okay.
Yeah, I mean, I've seen a lot of changes, and certainly, I think just to everybody now, I think it's got way too political now, and which sort of for me makes it less sensible as a business. I always have grave concerns when judgments are made based on politics rather than what is good business and what provides a service. And I think the problem is, excuse me, turn that off.
Okay, maybe you could put.
Yeah,
if we could put this gentleman back on mute while his phone's ringing, and maybe we can come back to you a little bit later.
Yeah, done.
Very good, thank you. Interesting feedback. I agree with you. It has become very political as a business. It's much tougher than it was when I got into it in 1989. That's for sure. Much easier to make mistakes, and much harder to get it right and turn a profit. And that's why the tax structure, for those of us who are going to hang on in there, is very, very important. Now, somebody has just asked a question. I'm really interested to hear what structure to have going forward. I'm just trying to move forward from having one single let property. Okay, now on a open video conference like this, you'll appreciate that we can't give advice in isolation of all the facts. And to be able to give proper advice, then we have to go through a number of checks and balances. We have to do money laundering checks, for example, to make sure that we're talking to the right people and giving the right advice. We have to go through a fact find to establish the details of the business. But what I want to do in this hour or so that we have here is just talk about some of the tax issues that landlords do have and answer those questions and talk about structures more generically. And then if people do want to book a tax consultation on sort of for bespoke guidance, they can do afterwards. So let's just talk about some of the issues that people might have. So if you're a sole owner or a joint owner, but sole owner first of all, if you're a sole owner, there's very little you can do in terms of your profits. So you're going to pay profits at your marginal rate of tax. You're not going to be able to offset your finance costs against your income to arrive at those profits anymore as of 6th of April this year. You are going to get a 20% tax credit equal to your finance costs. So the bottom line is, if you're a 40% taxpayer, you'll be paying 40% tax on your finance costs and only getting 20% allowed back. So you're going to be significantly worse off. You might have actually found that you were a basic rate taxpayer, but by the time this finance cost is disallowed, then you are a higher rate taxpayer, and this is starting to affect you. If you're a joint owner, you're in exactly the same boat. And what's going to happen the default position on a joint owner is that the income is going to be allocated 50-50. So we've got some feedback from somebody, Julia, who's unmuted themselves.
Let me find them.
Thank you, Julie. Okay, so well, I was talking about the default position for a joint ownership. So the default position is that it will be 50-50. That can be changed by setting up or filling in Form 17, submitting that to HMRC, and that will require, if there's a joint tenancy, for the joint tenancy to be severed, leaving. So it doesn't change your mortgage scenario. You're still the owners. But if the joint tenancy is severed, the default position is 50-50 ownership, and the declaration of trust can say how that ownership is split. So that's one way. So if you've got one partner or your spouse, for example, who's a lower rate taxpayer and you're a higher rate taxpayer, you can kind of adjust your profitability by doing that. But pure joint ownership is 50-50, and you can't just decide because it seems better for you to allocate a chunk of your profit to your spouse if it seems cheaper. There's ways and means of doing that. So the Declaration of Trust and Form 17 is one. A much, much, much more flexible way of doing it is to become a partnership. Now, very interestingly, most accountants never consider, and most of our business comes from accountants, by the way, but most of the accountants don't consider that people who are already joint owners might actually already be a partnership. And they don't register the fact that they're a partnership with HMRC. They just carry on dealing with things as joint owners. And it's actually relatively simple to form a partnership, and maybe we can answer some questions on partnerships. But it may well be that some people, by the definition of the Partnership Act 1890, are already partners. Mark Smith, do you want to just give us some more background on the law in that case?
Yeah, certainly. There's no formality needed to be a partnership. You don't need to have any partnership agreement. You don't need to have a registration of HMRC. All you need to be is two or more people carrying on business together with the view to profit. So if you have joint owners who are both on the mortgage, so they're both liable for any liabilities of the business, they share the profits in whatever proportions they determine between them, they both work in the business, either they've contributed capital, they've put their time and effort into the business, that is a partnership business, so long as there's sufficient scale involved in the undertaking. So that you don't need to have any formality involved to be a partnership. A lot of people are in partnerships without even knowing that that's the situation.
Indeed. And it actually goes the other way around as well. Some people have registered as a partnership, but as you said, the definition, the key word in the definition is business. Yeah. So it's two or more persons engaged in business. But if HMRC don't regard you as a business, the fact that you've registered a partnership doesn't necessarily mean you are one.
Absolutely right.
Yep.
So where does that leave people, Mark, if, for example, they're registering for the first time with their property business? Has HMRC got any sort of criteria that you have to meet to be classed as a property business? Or is it a case of as long as you've got a property and you're earning money from it, therefore you've got a property business?
It's a great question. The answers are all over the HMRC manuals. And you asked me to talk about Property 118 TV, and I said I'd park it, but I'll talk about it now, because one of the first videos that we did on Property 118 TV was asking the question, what is a property rental business? And Property 118 TV, what I decided I wanted to do is create short videos, 5 or 10 minutes long maximum, to answer questions like that. That's the sort of fundamental key issues. I hope people are taking notes, and I know this is going to be recorded so they can play it back. But in that video, I pointed people to the Property Investment Manual. So there's lots of hearsay, there's lots of rubbish, particularly on Facebook, where people try and answer other people's questions. Whenever we make a recommendation, we always back it up with legislation or reference to HMRC's own internal manuals. Now, you'd think that the HMRC's tax inspectors' manuals are some kind of secret. They're really not. The only problem is I've been told that there's 12 million words in them. And I don't know whether that's actually true, because I've never bothered to count them, and I doubt I ever will, but it sounds about right. So the problem that the general public have got, and when they've got a question, is how do they find the answer? So if you just type into Google, for example, HMRC PIM 1020, I haven't got it in front of me, so forgive me if I don't say it word for word, but the long and short of it is that manual says that any person who owns property and lets that property out for income is operating a property rental business. And for taxation purposes, that is the baseline. Now, there are then other further HMRC manuals. For example, there's one on national insurance contributions. So if you wanted to put in, if you did a Google search on HMRC, National Insurance Manuals, Property Investment, that will give you a different definition, which says if you are earning more than a certain amount of profit, then you have to register for Class 2 National Insurance, depending on certain circumstances. It also says you've got the option not to register for Class 2 National Insurance. That's currently £3.05 a week. I would say to any landlord, go and register yourself for Class 2 National Insurance if you're not paying National Insurance anywhere else anyway, because it does two things. One, it qualifies you. If HMRC will say, okay, well, it's a business, you're paying the National Insurance contributions. The second, but perhaps most important thing, is that you'll then still qualify for your state basic pension when you get to that age. If you don't pay any National Insurance at all, then you're not going to qualify for the state basic pension. So there's a second piece of legislation there. And then the third and most difficult one is HMRC's meaning of business test for incorporation relief. Now, a lot of people, a massive question that gets asked all the time is, my properties are all in my name, my joint names, or in a partnership, and we want to put them into a limited company because we've heard that the limited company doesn't pay or isn't affected by the Section 24 restrictions on finance cost relief. We want to offset our finance costs against rental income. But the problem with putting it into the limited company is effectively we're making a sale to a third party, and that would trigger capital gains tax. Oh, thank you, Mark, for putting the link up to that YouTube video, by the way. Really appreciate that. So there's another definition that allows this relief called incorporation relief. And what incorporation relief does is allow people to roll their capital gains out of their properties and into the shares in the company that they're transferring the properties to. Now, HMRC's definition of business to qualify for that relief is different again. And it's based on two pieces of case law. The most famous one that landlords talk about is the HMRC versus Ramsey case, where Mrs. Ramsey lost at the first tier tribunal and then won at the upper tier tribunal. That case is Mrs. Ramsey owned one property, split into 10 flats, of which 5 were let. HMRC said, this is not a business. She argued, yes, it is. I've spent 20 hours a week doing this. I've refurbished the property. I've got planning permission. I cleaned the hall, stairs and landing, and I spend 20 hours a week. Of course, HMRC had to accept her word for that because they couldn't sort of send a man in a white coat with a stopwatch to do it, to actually time her doing this. And if they had, I'm sure she would have been the slowest cleaner in the world. So they had to accept that that was the case. So in that particular ruling, which goes back to 2013, the judge accepted that Mrs. Ramsey was running a business and allowed the incorporation relief. And interestingly, HMRC haven't challenged that since. But it is the most difficult test to meet for HMRC's proof of business. And we always say, make sure you take professional advice on this. And that's not necessarily from the accountant or solicitor that you would always use. And we work in Property 118 Tax. We have a team of consultants that work on these types of issues on a daily basis. We have an ongoing relationship with lots of accountants. We have structures to enable to identify whether HMRC will accept people are both a partnership and a business and qualify for release to switch over to a limited company structure. So, just dealing with your accountant might not be enough. So what we tend to do is we work with the client, the accountant, maybe their existing financial advisors, mortgage advisor, or any other advisors they've got. And we work as a team. And then once we've come up with the solution, then that's when we'd get Mark Smith involved as counsel. And he will effectively, if he agrees with us, he'll put his professional credibility on the line. He'll put his professional indemnity insurance on the line and say, yes, or, yes, this is the way to go and you qualify for these reliefs. Mark, do you want to add anything to that?
No, you summarised it very well. Obviously, more often than not, I do agree with the recommendations that the consultants make, because we've worked on developing responses to certain situations, between us, so we know pretty much what the recommendation is going to be when we get presented with a certain set of facts. But of course, everybody's case is different, so everybody gets individual consideration because that's what's necessary.
Absolutely. And one of the things that we get regularly, Mark, as you know, is people who say, well, I've got 10 properties, they're jointly owned, am I a partnership or not? And they haven't registered necessarily as a partnership. And of course, we've now got a way, we know the non-statutory clearance team closed down in Southend-on-Sea in 2018 spring. So we can't get non-statutory clearances anymore. But as you know, we have ways and means to identify whether HMRC will accept that a partnership exists.
Yes, we do. Yeah, we're not going to say too much else about that, but we can give comfort to the clients in that circumstance, and there's ways we can do it to guarantee that they won't lose out on the tax relief that are available.
Indeed, in terms of working with accountants. Julie, I've rabbited on for quite a long time. I mean, do you want to start asking some of your questions? Because I don't want to take up all of the time just burbling on what I think people want to hear. It'd be great to actually get questions from the audience or the pre-submitted questions from yourself.
Yeah, like I say, I do have some pre-submitted questions for you. The first one is expenses for landlords. What can they claim on their tax return? Because obviously that changed a little while ago. And this particular person's just wondering now what they can claim back on maybe refurbishment or something like that.
Okay, that's more of an accountancy question than a tax planning question. I'm quite happy to answer it. But I'm not an accountant, I'm a tax planner. Let me give you the definition of the two. My wife, by the way, is an accountant. So an accountant will deal with the compliance and the reporting of something that's already happened, typically. Some accountants will also do tax planning, but they're very, very few and far between because their training is very much more about accounting for what has already gone before and doing it in a compliant way. Tax planner will look forward and say this is the best structure to be operating within, but the nitty gritty of, should I buy a car or should I lease a car, or can I claim this as, is this a maintenance expense or is this a capitalized expense? They are generally accounting questions. I'll start off with the big one. What can you not claim now that you could claim before? And the big one that you can't claim now is if you are an individual landlord, a joint owner landlord, or a member of a partnership or an LLP, you cannot offset your finance costs against rental income. That's the massive change. It's been phased over the last 4 years. As of the 6th of April this year, you can't offset any of your finance costs against profits, against rental income. Other things you can still claim for, depending on how big your rental business is, use of home as office, obviously your materials, your professional accountancy fees. You can offset things like your gas safety certificates, your CP12s. You can offset your NEIC reports if you have to have those going forwards. You can offset your insurance. You can offset your ground rents. You can offset your service charges. So most stuff. So when you hear people say, oh, well, landlords are taxed on turnover now, that's not true either, because we are taxed as a business, but we can't, as individual landlords, offset our finance costs. And that's where tax planning becomes really, really important. If you're going to go into a position where you become a higher rate taxpayer as a result of not being able to offset your finance costs, then you need to do some serious planning. Now, that planning may not make an immediate difference, but might in the future. And planning doesn't necessarily give you an instant result. Sometimes it can be a deferred gratification type scenario. And sometimes it's possible to transition immediately from one structure to another without paying any tax in doing so, and actually be substantially better off. So that's where the tax planning that looks at the legal aspects of what is achievable is very different to accountancy-based taxation.
That makes sense.
Hopefully that answers that question.
Thank you very much. We've just had a question come in on the chat from Susan Law, wanting to go back to the national insurance contribution question. I don't know, can you see that up in the chat?
I can. I can also show you the national insurance manuals if you bear with me just a second. And bear with me a sec. So national insurance manual, There it is. So if I share screens now, host disabled participant screen sharing. Can you give me the ability to share screens?
I don't know.
No, never mind. Right, okay, I'll tell you where, for those who don't know, that if you look at my YouTube channel, Mark Alexander Property 118 TV, I've actually done a video on this. But if you want to read more about national insurance, it's, if you just type in HMRC, this is into a Google search, HMRC, then do space and do NIM for National Insurance Manual 23800, you'll be able to read what the rules are on national insurance and some examples as well. So hopefully that answers that question. If you need more, go back to my Property 118 TV channel, and there's a lot more information on that as well. It's only about a 10-minute video.
We've just had a question come in from Adam. Interestingly, that was the next one on my list as well, so that's coincidental. Talking about interested in incorporating his property business, has been set up as a partnership for a number of years. So, you know, looking at the partnership returns and his concern around loans that already exist.
Yeah. Can I just ask one quick question, Adam, if you can answer this one in chat? Are all your properties in England?
Yes.
Yes, they are. Excellent. Right, great. So there's different rules depending on whether you're in England or Scotland, and sometimes Wales and Northern Ireland as well, hence that question. So there's the main structure that we use now to avoid the necessity to refinance is a structure called substantial incorporation structure. Now, actually, I've done most of the talking. Mark Smith, do you want to explain the basics of how substantial incorporation structure works? In fact, before you do, Mark, before you just jump in there, let me explain why somebody wouldn't necessarily want to refinance at the point of incorporation, and why people might expect that they have to. When you incorporate, what you're effectively doing is selling your business from your own ownership into a limited company in exchange for shares. So your equity in the properties now becomes shares in the company, and the company owns the equity in the properties. And normally if you sell something, then the finance has to be repaid and somebody else has to, and then the new buyer, i.e. the limited company, has to take on the finance to buy it. But that isn't always the case. So substantial incorporation structure has nothing whatsoever to do with tax. It's how to avoid the cost of refinancing at the point of incorporation. Mark Smith, can you give us a little bit of background to that one?
Yeah, certainly. The idea of it is that the assets of the business, your rental business, are the beneficial interest in the properties. They're not the actual ownership of the properties, because you're not buying and selling the properties, you're renting them out, using them as cash generating assets. And so the assets for HMRC's purposes are the beneficial interest, the right to the economic benefit of the properties. So if we sell the beneficial interest of the properties to a company, we don't have to refinance, because the financing attaches to the legal interest. That's the interest that's registered at the land registry. And so we separate the legal ownership, which is where the mortgage finance lies, from the beneficial ownership, which is where HMRC is interested in. And we sell the beneficial interest to the new company in exchange for shares. That means that the capital gain that would otherwise accrue on the properties is postponed and added to the share value rather than the property value itself. So you'd only pay that capital gains if you actually disposed of the shares rather than disposed of the properties. And the financing remains where it is until it becomes commercially worthwhile or necessary to refinance the loan into the name of the company. So in answer to Adam's specific questions, would my current lenders be happy with the incorporation? If they ask them advance, would they say yes? The answer to that is, well, we don't tell them, because it's not any of their concern. Their security is unaffected by this substantial incorporation strategy, because their rights at the land registry override anything that's done with the beneficial interests. So they would not be happy, because if you're asked anything for the first time, your first reaction is to say no, and they might be able to write you some more slightly more expensive mortgage products. So we don't ever ask them in advance if we can do this, because we don't have to. unless there are specific terms in the loan that requires us to do so, and there very rarely are in single let BTLs. In the second question, will I be able to get new mortgages going forward when a potential lender is aware of what I've done? The answer to that is yes. We have access to specialist mortgage brokers and specialist conveyancing lawyers who have piloted many of these refinancings through when the time comes to move the financing into the company. It's a question of explaining to the lender, because this is all still pretty new to many lenders, explaining to the lender and the underwriters what we've done, why their security is unaffected, and how their security will be perfected after we've carried out that transaction. So the answer to question 1 is no, because we don't tell them. And the answer to question 2 is yes, because we've done it many, many times through our experience in the field.
Yeah, I think the key point to substantial completion itself, Mark, is that if the point at which capital gains tax and stamp duty is triggered is on exchange of contracts, correct?
On substantial completion, that's right. It's basically, it was an anti-avoidance method, because you can imagine if you buy a property and you say, well, I'll give you the entire purchase price as the deposit, but we won't complete it for 30 years. Then if the SDLT was payable on completion, you'd never pay it, because you'd have to wait 30 years for that to be completed. So HMRC has got round that by saying, well, you actually pay at the time of substantial incorporation, i.e. a substantial transfer, when you move into the property, when you take over control or occupation of the property. So we're taking that anti-avoidance and using it for the benefit of our clientele, rather than using it as or seeing it as an obstruction. So yes.
And that's not just stamp duty, it's also capital gains tax as well. It works on the same basis. It's the point at which the transaction completes substantially rather than completely.
That's correct. So if you exchange contracts and then the company takes over the operation of the asset as an asset of the business, rents it out, etc., that is sufficient for that to be triggering the tax point for CGT, and then that creates your exemption from CGT by incorporating.
And HMRC can't have it both ways. Obviously, they can't say the stamp duty is due, but you can't claim the stamp duty relief that's available to partnerships yet. And likewise, they can't say, well, the capital gains is due, but you can't claim the capital gains exemption yet. It's either one or the other, and they've made the law that says that the taxes are ordinarily due at the point of exchange, and on that basis, so must the relief be.
Absolutely right. Yes. So we're taking that those anti-avoidance provisions, and using them for the benefit rather than as an impediment.
Yeah, and interestingly, the thing that I think comes up quite a lot, mortgage brokers obviously don't like this idea particularly, because they want to rewrite your mortgages when you transfer from a partnership to a limited company. They want to write new mortgages. That's the business they're in. So they throw up false things like, oh, well, we've got to get the lender's permission. Well, since when did you get the lender's permission to sell your property and exchange contracts? You never did. But of course, if they ask for permission, it's something that the lender doesn't understand. The lender's answer is invariably, well, no, we don't understand it, so we won't do that. And of course, it means that it pushes people into the remortgage that isn't necessarily the right thing to do for them, because they might be tied into early repayment charges. They might have mortgages that were written on historically very low interest rates, for example, the 1 over base, 1.5 over 2 over base trackers that were done sort of pre-credit crunch. So be very aware that your mortgage broker might not give you the same answers as we do to this question, because they do have a vested interest in you actually remortgaging. So that would be my...
Adam's asked a supplementary question. If we transfer the beneficial interest of the property to Newco, how do you get tax relief on the loan when this still remains in the partnership? Do we transfer the loan? Well, the answer to that is no, we don't transfer the loan. What happens is that the company has a contractual relationship with you as the seller of the business to the company. And part of the consideration that the company gives when you sell the business is an obligation to take on the debts of the partnership business. So the company owes you the money, you owe the mortgage company money, but it's the company's debt for business purposes and taxation purposes. And so,
Indeed, you effectively have two contracts, don't you? You have one between the borrower and the mortgage lender, and then a subsequent contract between who was the borrower, i.e. the business owner, and the new business owner, the limited company. So they run together. And this is a question that also comes up on a regular basis. People say, well, how can you claim the tax relief? Well, it's no different to a letting agent collecting rent on your behalf. The letting agent doesn't pay tax on the rent it collects for you. The letting agent only pays tax on the commission that he charges. So essentially, when you put these contracts into place, you're becoming the agent on behalf of the company. So you are simply making the payments, and because you're not charging the company a commission for that, then there is no tax on which to pay. So there is no income on which to pay any tax.
yeah, it's the company's money, it's the company's obligation. So it's not personally taxable on you because it's not your money any longer. The company's the beneficial owner.
Indeed, indeed. Back to you, Julie. More questions?
Yeah, thank you.
Oh, by the way, sorry, one quick one. Susan, I did answer your question. I put the links in the notes section. I didn't realise it was going to put them all in together. So there's actually, it sort of merged all the links. But hopefully from those you can get what the links were.
Yeah, Susan says she's found it, so that's good.
Yeah, excellent, very good.
Perfect.
Sorry,
okay,
Julie.
my next question is regards overseas properties. So if we are landlords here we live in the UK here, the properties are overseas, but they are being rented out as holiday lets. What's the tax implication there? Do you pay tax in that particular country, or do you still pay tax in the UK?
You do indeed. It's classed as the same. It's taxed in exactly the same way as the other property investment is. So it is treated as a business for taxation purposes. However, it's treated as a separate business than your UK property business. So if you've got, let's say, 10 properties in Spain, for example, and you've got 10 properties in England, that's not one business, that's two businesses. Now, I talked to you about the HMRC Property Manual PIM 1020. The property manual that explains this is PIM 1025. And I'll read that because I can't put it on screen, but it actually says, what is an overseas property business? The definition of an overseas property business is identical to the definition of a UK property business, see PIM 1020, except that the land from which the income arises is outside the UK. An overseas property business is a separate business from a UK property business. So that gives another scenario. Let's say you've got a business in the UK that you want to incorporate, but you don't want to incorporate your property business overseas. One of the criteria for incorporation relief is that you have to incorporate the whole business. So you can't just say, well, I've got 25 properties, I want to incorporate 20, but keep these 5 because they're my favourites. Yeah, it's all or nothing. But the whole business is the whole business of your property business in the UK, and if you've got properties overseas, that's another business. Does that make sense?
Absolutely, thank you.
Cool.
The next question is regarding multiple dwelling relief and buying blocks of flats.
Oh, Mark Smith, you're the expert on this one. I know it, but I'll let Mark answer this one.
Okay, what's the question?
When buying multiple dwellings, apparently there is a multiple dwelling relief.
There is.
The person just wants to know a bit more about it because they've read about it but not actually gone through the motions.
Okay. First thing is, don't be put off by the fact that you may be buying a block of flats or a number of dwellings on one title. SDLT is charged on the number of dwellings rather than the title number itself. So if you buy a block of 6 flats, you're buying 6 dwellings, and so you can therefore subdivide the SDLT into 6 times what it would be if you bought 1 dwelling. Okay, so you wouldn't pay the SDLT based on the headline price of, say, £600,000. You would pay SDLT based on the SDLT that would be paid for 6 times 100,000. So that would often amount to a significant saving. Additionally, if it's 6 individual dwellings or more, you can put that through as a commercial SDLT purchase. But again, that may be beneficial, and the manuals say you can choose whichever brings you the best outcome. So a dwelling it applies to HMOs as well. If you have a dwelling that has an ensuite bathroom and some cooking facilities in the room, that is a separate dwelling for SDLT purposes. So you may buy a 5 or 6 or 7 bed HMO. If each of the rooms has got a separate dwelling, a separate private door with cooking and washing facilities and a bed and a chair and possibly a window, you've got 5, 6 or 7 individual dwellings for SDLT purposes. Now, if anybody has actually bought anything that fits that description, and you are concerned that your conveyancer hasn't advised you about multiple dwelling relief, or you think you may have overpaid, then please get in touch with us and we'll carry out a review of the situation and make sure you haven't overpaid. If you bought the property in the last 12 months, you can resubmit the SDLT with the relief being claimed and you'll get a refund. If you bought it in the last 6 years, but more than 12 months ago, then we can sue your conveyancer for getting it wrong.
And that, correct me if I'm wrong, Mark, that's one of the very few things that you will ever do on a no-win, no-fee basis.
It is, because there's not a lot of risk in it because we know what the criteria are. So yeah, I don't go to court as often as I used to, but that's one situation where I would be happy to do so.
Brilliant.
When I first talked to Mark and Ats mentioned no win, no fee, he said I do a different deal than that. He said no win, no fee, no me. But we have actually managed to find a basis on which Mark will take no win, no fee. If I could just expand on that question a little bit, Julie. I had a client who was buying a block of 20 flats in Great Yarmouth, and Great Yarmouth is quite cheap to buy big HMOs, and it was 20 self-contained dwellings, and the purchase price was 795,000. Now, if you look up the stamp duty on 795,000, it's a considerable chunk of money. However, given that there was 20 flats, each flat has a value of under £40,000. So the rate of SDLT that was actually paid was the minimum under the SDLT multiple dwellings relief rules, and that client only paid 1% stamp duty. There was no 3% stamp duty because each dwelling was under 40,000, and so technically you could say, well, actually, if the property's under 40,000, it's nil. But the way multiple dwellings relief works is it takes the total number of dwellings, and then it applies. If the answer is nil, it applies a minimum 1% fee. But instead of paying, I forget what it was, 30-odd thousand pounds that would have been payable in stamp duty land tax, they paid 7,995 or whatever 1% came out to. So multiple dwellings relief can make a massive difference. It's not just blocks of flats. As Mark said, it can be HMOs. I've used multiple dwellings relief in the past when I was buying aggressively. I used to go in end of development scenarios and say to the developer, look, you've got 7 units left. I'll take them all. I want a big discount. And then, of course, I could use multiple dwellings relief because some would be higher value, some would be lower value. And overall, I would often come out the winner as a result of using multiple dwellings relief. So a very, very useful tool to have in the box for anybody who's buying multiple dwellings.
Absolutely. Fantastic. Thank you for that. Another question. When creating a property development company to buy or control land or planning or development gain, would you create a separate SPV company for each development? If so, what's the rationale?
Possibly. This is one of those depends type answers. I'm a big fan of, if you've got trading businesses, to have a group structure, because if you've got a holding company, we'll call it Topco, and then you've got subsidiaries, it might be your buy-to-let investment business, your property development businesses, numbers 1, 2, 3, 4, and 5. All of the profits from all of those subsidiaries can flow to the top company, and then the top company can lend to whichever subsidiary needs the money. And now that way you don't end up declaring dividends on your trading business and then reinvesting your tax dividends into property. The dividends that flow into company are completely tax-free. From a risk mitigation perspective, then yes, I would certainly recommend a single purpose vehicle company for a development, even though it might be a subsidiary of a group. And the reason for that is if that development goes horribly wrong, it doesn't take out all of the rest of the assets of the group or you as an individual.
Okay, that was a question that came through on chat. Does that answer your question, Chris? Yeah.
Yeah, that was good. Thanks, Mark and Julie.
You're welcome.
Thank you very much. So it really brings me down to sort of the last of my questions that I had on my list. So I'm really hoping that you guys on chat are raring to go now, because you've seen how easy it is to be done. And basically the last couple of questions I've got revolve around Section 24. And one of the main questions is how to avoid it. And the second question is, if you have to pay it, what's the best way of getting, how did they word the question? With Section 24 being such a problem, what's the best way to take a business forward if you've been caught by Section 24, but moving forward you don't want to be?
Okay, so the first question is, what ownership structure are you now? Would an LLP or a partnership be better for you? What do you want to achieve going forward? We find that most people that find themselves in the Section 24 problem are tending to be in their late 40s at the earliest and older. And that often means that they've got children who are 18 years and above. So those children now have their own tax allowances. They may be going to university. They may even be working because they're in their 20s and they've got jobs, but they're not higher rate taxpayers themselves. And when we talk to these types of people, we say, one of the questions we say is, appreciate you're probably doing this to provide yourself with an income in retirement. Are you also doing this to provide a legacy? And they say yes. And we say, do you see yourself managing these properties when you're in your 70s, 80s and 90s if you live that long? Or do you see yourselves bringing in your children so that you can enjoy your retirement a bit more and get them perhaps running the business? And they say, oh, that would be lovely. They're not really showing an interest yet, or some maybe, and so on. Where that's the case, there's usually a fantastic opportunity, because if you've got Mr. and Mrs., for example, or just Mr. and kids, or Mrs. and kids, if they're a divorced couple type scenario, or even an unmarried scenario, then you could have a partnership between the family. And instead of having just one or two people with £50,000 worth of basic rate tax allowance to utilise before you're affected by Section 24, you start inviting the children in, that's an extra 50,000 of basic rate tax allowance you've got to use. So, you know, your typical sort of mum and dad and two kids could earn between them £200,000 before being affected by Section 24, as opposed to 100,000 between them. Sometimes what we find is that, you know, the highest rate earner, somebody who's earning maybe 65,000 a year, has bought all the properties in their name because it was easier to get the mortgages. The spouse, whether it be husband or wife, the spouse is earning a smaller or no income at all, but they're not utilising those allowances. So by forming an LLP, you can, or a partnership, what these structures can do is allow you to allocate the profit disproportionately to the ownership. So a person can still control the ownership of the business, but and have all the voting rights and all of that sort of thing, because they're putting all the capital into the partnership, but the profits can be allocated disproportionately. And of course, there are rules that you've got to be very careful of, like you don't want to be seen to be abusing the tax system, so the general anti-abuse rule has to be considered. But where you're doing something like this for a legacy planning purpose or a business continuity planning purpose, you know, you're ticking more boxes. You're not just doing this to save tax, which is a very important thing. And that's again why, you know, a consultation with a tax planning consultant who's used to this forward-thinking approach will be able to ask the right questions, provide the right guidance. So LLP partnership is definitely one to consider. If somebody's already a partnership, and as Mark said earlier, they might be a partnership by de facto and not actually realize it, then incorporation is another opportunity to consider. And sometimes it's a case of both are actually feasible, and we have to look at which one is actually going to produce the better results. But the structures that are usually the The better structures are partnership, LLP, and limited company. And the important thing is to find a way to transition from where you are now into one of those structures to take you to the destination that you ultimately want to end up at.
Thank you. Just had another question come in on the chat from Adam. One tax that is often forgotten about for landlords is IHT. How do you ensure joining up thinking for business structure?
Well, I think that's again where working with people who've got the background in property finance, tax and law is very, very important. So, you know, a solicitor, an IFA, an accountant and a mortgage broker might come up with 4 different solutions. When you plug them all together and you've got the barrister like Mark Smith behind that as well, that's when the magic really tends to happen. I totally agree, IHT is overlooked. And let me give you an example of that. We regularly talk to people who've got sort of £5–10 million property portfolios. We also talk to people with £1 million property portfolios. So let's take the lowest common denominator. Let's say somebody's got £1 million property portfolio and £500,000 worth of mortgages between husband and wife, maybe with their house. It's borderline as to whether they're going to have an IHT problem today. However, if that property portfolio doubles in value, all of a sudden their net estate has gone from, let's say, £500,000 to £1.5 million. If it doubles or trebles or quadruples in value, it could be adding millions to the value of their estate. And of course, for every £1 million worth of capital appreciation a landlord gets, that's an extra £400,000 in inheritance tax that their next of kin or their beneficiaries are going to have to end up having to find. And people always make the mistake as well that their kids will just inherit the properties and they'll be able to sell them and pay the inheritance tax. Well, actually, that's not true either, because you don't actually get the ability to sell the properties until you pay the inheritance tax. So it can create a real problem for people. Now, solutions to this, again, depends on which way we go. If we go down the LLP route, then of course, if you're allocating a substantial amount of profit to your children, allocation of profit is not the same as actually giving it in them to spend. So I could, let's say, for example, if I've got 2 twins who are aged 18 and are going to university, I could allocate 50,000 of profit to each of them. They'd pay their tax on that 50,000 of, say, 7,500. I could allow them to draw the 7,500 to pay the tax, but make the rules in the partnership to say the other 42,500 each is retained until the day I die. If I live another 20 years, you do the maths, 42,500 times 2 times 20 is a whole lot of money that's left my estate and gone into their estate on paper that's no longer exposed to inheritance tax. On a limited company scenario, again, there's another way to do it. Mark Smith, can you talk a little bit about freezer shares so that people don't get bored of my voice?
Yeah. On moving the business into a company, we can set up a share structure that gives the original owners of the business complete control, voting and dividend rights, but only rights on a distribution of the company. So if the company was sold or liquidated, they would get a payout based on the value of the company at the time of incorporation. And then a second class of share that doesn't have any voting rights, doesn't have any dividend rights, but has the right to the accumulation of value from the value at the date of incorporation onwards. So if, taking Mark's earlier example, if the property business lasts 20–25 years and the capital value of the business increases 5, 10, 15 million pounds, then that 5, 10, 15 million pounds would attach to the second class of share and therefore would not be subject to IHT when the original proprietors of the business pass away and their IHT come to be calculated. So you're basically freezing the value of the business for IHT purposes in the hands of the original owners at the incorporation date value. Any capital increase thereafter stays outside their estate and is got into the hands of their chosen successors, either by direct allocation of the shares or by setting up a discretionary trust strategy.
Very good. Does that answer your question, Adam? Maybe we could unmute Adam and see if he can expand a bit on his question, Julie.
You should be able to unmute yourself, Adam, if you want to. There we go. Now, Adam, you're all unmuted.
Hello, Adam. Are you still there? Oh, he can't talk at present. He's gone a bit shy.
Okay, I'll mute him again. Right.
No problem. Right, any other questions, guys?
So the last question that I've got on my list, it's a bit of a general question. And the question is, when looking at getting into business, so not just necessarily like we're talking about tonight, property, would you say that people should just pick one thing to do in a business? So should they just pick property, or should they pick a bit of property, a bit of stocks and shares, a bit of something else? What would be just a general term for someone to be getting into business for?
Interesting question. For me, property, finance, tax, and law has been my chosen career. So I've parked property money into property, but then worked on all of the other aspects as well. So I guess that I would say, for me, I like diversity. I've invested into several different property classes. I've used all of the different pension structures like SIP, SAS, and SURF. SURF is the one that everybody says to me, I've never heard of that one. That's a self-invested retirement fund. So I think it's very difficult to answer. If you were to talk to an independent financial advisor, they would say diversification in asset classes. So have some of your money into stocks and shares, some of your money into gold, some of your money into commercial and residential property, and so on and so forth. But I don't know, what would you say, Mark, to that question?
I wouldn't like to say. I mean, I'm fortunate that I've got one or two other non-property related business interests, so I'm sort of diversified in terms of being legal advisor for a couple of other companies. But in terms of an overall investment strategy, then I just sort of see what comes in and try to make the most of it. I've only got a strategy as such.
Indeed. I think Adam came back and said we have answered this question though. So thank you very much for that, Adam. Des Taylor, you've got a really good audience here, Julie. Do you know Des Taylor?
I do, yes. Me and Des had a conversation not so long ago. Yeah, I know Des quite well.
I've been communicating with Des loads over email and stuff, but I've never actually met him. Hello, Des. We meet at last. Yeah, I can see him waving. Can we unmute Des and just have a quick chat with him?
Yeah, absolutely. Can you unmute yourself, Des, or do you need me to do that?
I can do that.
Fab. Hiya.
Well, the reason I wanted to unmute you, Des, I just wanted to say thank you for that excellent review you did on Property 118 Tax. Property 118 TV. Maybe you could just share your thoughts on this video conference with us.
Yeah, well, when I saw what you were putting out, the first thing I realised was the short video is very, very engaging. It's very, very easy for you to understand what you're trying to say. And not many people know this, but I started my days out working in an accountant's office, doing PAYE tax and a little bit of corporation tax as well. So I love people being able to take what people find quite complex and simplifying them. And that's what you were doing. And the most important part was all the links. It was like, oh, go here and you'll find it. And these manuals are not as complicated as people want to make them out, but it's just like reading the law. Once you've read them enough times, thousands and thousands over, it's easy to articulate them. And that is what you do very, very well. And for me, I just kept looking at them going, this is simple. It's very easy. And I just felt compelled to write something about it because there's so many people putting stuff out there. How are you supposed to know what's different or not? And like yourselves, we at Landlords Licensing and Defence, we don't put out stuff out there that isn't fact. Most people are putting stuff out which is, well, that's my opinion, that's what I think, and quite frankly, it's quite scary. So yeah, it's great to have somebody who's talking about tax in the way that they should, and you're also doing a number of things that I've been doing for a number of years, because the grounding I had was it's always optional to pay tax in most countries, and most people don't understand that. So it's fantastic. What I like, everything about it, Mark, has been really, really good, and I just can't wait to see more and more and more of it, because it's these little nuggets that like get us thinking. And when we get thinking, that's when we realise what we've got a hand on and how we can avoid having to pay far too much tax to the taxman. And I think I've done quite well over the years, not giving him too much money.
Very good. Yeah, thank you for that. What I've been trying to do, Dave, is I'm going to try and release them the way Netflix does. So allow people to binge watch them, because they're only sort of 5-10 minutes long. So, you know, releasing a 5-minute video every week, I don't think is really going to set the world on fire. So I'm trying to get it so I'm recording 10 and then release them. And then that maybe happen every sort of 2 or 3 months. Then people can binge watch that 10. And then, of course, I can base the next videos on the answers that come in over the next 3 months, or the questions that come in the comments sections over the next 3 months. But I'm glad.
Fantastic idea. Fantastic way to do it, because there are going to be periods, as you and I well know, there are periods of the year when people are going to start looking at their taxes, and a lot of them are going to do that towards the end of the summer, towards the end of the year, and of course they're going to do it towards the end of March again. So.
Absolutely. I'm going to go onto YouTube and just give people a link, unless maybe somebody could do it for me quicker than I can while I'm talking. So if I just cut over YouTube, Mark Alexander, Property 118 Tax.
While you're doing that, Mark Smith, do you want to take the question from F. Thomas in the chat?
Well, I was just reading that question. We quite often say in our conferences we don't get anything asked for the first time. I've never been asked this before. It's really more for Mark A to look at. When properties are in a company, how do different lenders treat the cross-collateral issue? Different lenders don't want their respective securities compromised.
That hasn't actually never changed. Oh, by the way, I'm just about to type in a link to Property 118 TV for everybody. Apologies that it's a horrible looking link. I need to get that sorted. The answer to the question that was raised about the cross-collateralization issue, that's always been a problem and always will be, because lenders do set the rules, unfortunately. So if lenders are saying we don't want a cross-collateralization scenario, we are only going to lend to a single-purpose vehicle limited company, then that's their rules, and you know, you take it or leave it. It's their money. You have to agree to their rules or not agree to their rules. There's not a lot we can do to change any of that. There are obviously some brokers that are better than others. So, you know, your normal high street broker is only going to use one of the sort of 5 or 6 different mortgage sourcing tools, whereas a commercial broker will have relationships with other lenders that will never show products on those mortgage tools, because they don't have products as such. They underwrite on a sort of commercial basis. So the likes of Handelsbanken, for example, Adam & Co. if you're up in Scotland, and there are many, many, many more that will underwrite on a commercial basis, therefore don't have a product. So the only way to access them is via a commercial finance broker. And when you get into that league of commercial lending, then what you will find is that more doors will open. So if you've got a group company and you're talking to one of these merchant banker type lending underwriters, they will have a broader understanding of what is achievable anyway, and may give you a different answer than your normal high street broker will give you. So apologies, that's not a sort of black and white answer to whoever asked that question. I can't remember who it was now. Was that
F. Thomas?
F. Thomas, yeah. But hopefully that's useful. I had no allegiance to any commercial finance brokerage, even though I was a commercial finance broker. If you want to look up some commercial finance brokers, type this into Google search, NACFB. That stands for the National Association of Commercial Finance Brokers. It's a not-for-profit organisation. It's a trade organisation and also a regulatory body for all of the commercial finance brokers in the UK. So that's going to be very different to your whole of market high street brokers that will do your vanilla buy-to-let products and your sort of first-time buyer type mortgages.
Fantastic, thank you. Has anybody else got any further questions for Mark and Mark? Everyone's gone very quiet on me this evening.
James Stewart.
Can anybody? Is this working?
Yeah, we can hear you.
Right.
James Stewart, you put your hand up. Can you hit the unmute, please, James?
No, I don't know how to put my hand up.
Sorry, we'll come back to you. Sorry, I didn't see your hand, Anthony. We'll come back to you afterwards. James, if you hit the unmute on the bottom left. Can't hear you, James.
I've got 2 HMOs in Aberdeen, in Scotland.
Yes.
And they're in my own name. I've also got a property in Dorking, which my partner's living in, but we've got an agreement that we'll be splitting it up soon.
Mm-hmm.
Now, I'm looking at ways of getting around the properties in Aberdeen. I want to get the money out, but if I get the money out, I pay a lot of tax. So could I create one of these substantial incorporation structures and move my properties in Aberdeen into a limited company and then borrow against that?
Possibly. I mean, you could possibly borrow against them at the moment, and that would be one way of getting your money out without paying tax. So just taking a larger loan against them, you wouldn't pay any tax at all on that because it's borrowed money. Of course, you wouldn't be able to offset all of the finance costs against your profits, but you would get 20% tax credits against those increased finance costs. So it might help somewhat. The answer, could you incorporate? The answer is yes. Would it be viable? We don't know yet. Now, can you tell me how many tenancies there are in those HMOs?
There's only 6 rooms in total, 2 3-bedroom. One's a 3-bedroomed house, one's a 3-bedroomed apartment.
Right, okay. And roughly how much time do you commit to that, running those as a business?
Well, I sometimes use agents for doing it.
Right, okay.
Right.
In which case, incorporation probably wouldn't be the way to go for you, because you'd end up having to pay capital gains tax because the incorporation relief is unlikely to be available to you because HMRC wouldn't regard it as a business. Also, you'd probably pay LBTT as well unless you're a partnership.
But at this moment in time, because things are really hard, I've been going up and renting them out myself. And that means trips from Cambridge to Aberdeen, which is quite a lot of time.
Right, okay. Would you say you do 20 hours a week?
Is that the minimum you've got to do, is it?
That's what the HMRC manuals say.
No, probably. I do certainly a lot more some weeks, but on average, probably not.
Yeah. And then the other thing is if you own them in your own name, you would pay LBTT. For those who are in England, LBTT is Land and Building Transaction Tax, which is almost the same as stamp duty land tax, except of course you pay an extra 1%. So you get stung with the 4% additional rate as opposed to the English 3% additional rate. So incorporation probably isn't the right structure for you. There may be other alternatives, depending on whether you've got other family members that you could form a partnership with and utilize their lower rate tax bands. Maybe a wife.
I've got a daughter, yeah, and a son.
Okay.
But one's working.
As I said right at the top of the program, we can't give one-to-one specific advice in isolation of all the facts. I would say probably incorporation is not the way to go for you, but I'm wording that probably. So it's not advice. There may be other ways, but I think we'd have to have a more discreet offline consultation to do that. And to book that, you'd need to go onto property118.com/tax.
Okay. Thank you, Mark.
Very good. Thank you. If you could unmute yourself now, and then the other gentleman whose name I've forgotten, but he spoke earlier, who put his hand up. Do you want to unmute yourself and ask your question now, sir?
Yeah, relatively straightforward. I sort of saw the writing on the wall and got rid of a fair amount of properties in the UK some time ago and bought elsewhere in Europe. Now they're incorporated in a company structure in that company, in that country. I've only got 42 properties left in the UK. Mm-hmm. Some are in my own name, some are in the name of a limited company. My own personal view in this country is I think residential property. I have commercial property, but residential property has a severely limited lifespan in this country. So I want to try and set myself up to the point I can divest myself of an awful lot of properties in this country. And various things I've considered, an LLP with a sort of beneficiary trust for the families. In a nutshell, I realise the more one-to-one thing, but what's the way to look at to do that?
Have you considered something far more creative, like going and living abroad?
Yeah, I have actually. Yeah, but I also have some manufacturing businesses in this country as well.
So you're tied to time in this business?
Maybe.
In this country, well, I say in this country, I'm in Florida, but you're in England.
Well, yes, but you know, you've got to give all sorts of thought to consideration. So, yeah, and you know, providing they loosen things up, it's not very long to get from Europe. And you can either.
Okay, well, we've covered two of the three key strategies for tax planning, landlord, LLP, and limited company. What I haven't talked about is living abroad, and so I'll cover that if I may, because I can't answer your question for the same reasons I go to the other chap. But by all means, book a tax consultation. But I think it does open up another angle for us to talk about. So thanks for the question, Anthony. If you move abroad and you sell your properties, then you no longer pay capital gains tax in the UK on any capital appreciation up to April 2015. So even if you bought property in 1990, for example, and it had made an absolute fortune by 2015, you don't pay any capital gains tax on all of that growth. You only pay capital gains tax from April 2015 onwards. Alternatively, you have a second option, which is to pay capital gains tax pro rata. So let's say you've owned a property for 20 years. You can say, well, there's 5 years gone by since April 2015. So therefore, that's 25% of the 20 years I've owned it. I will only pay capital gains tax on 25% of the total appreciation over that period of time. So HMRC is very, very generous and actually gives you two different choices. Now, the problem comes in whichever country you then live in. So if you decide to live in Spain, for example, they will say, oh, aren't HMRC very generous people? We'll have all the capital gains tax that HMRC would have paid you as a result of being a resident in the UK. And Spain's capital gains tax is actually higher than the UK's. So Spain would obviously be an awful choice to make. However, Malta, Cyprus, and Portugal, you don't pay any capital gains tax at all on overseas assets. Portugal is a subject to qualifying for NHR, which stands for the non-habitual residence scheme. NHRS, a non-habitual residence scheme. So you can put that into Google and it'll tell you all about it. The other wonderful thing about Portugal, and it's one of the reasons that I've relocated to Portugal for tax purposes very recently from Malta, is that if you are resident in Portugal under the NHR scheme, you don't pay tax on UK dividends either. Now, Anthony, you mentioned that you've got some property in a limited company. Well, obviously the way to get the money out of the limited company is by declaring dividends. If you were to live in Portugal, you wouldn't pay any. And on the properties that you may want to move into the limited company, it would significantly reduce your tax position if you were living in Portugal because of the other rule that I've explained, which is CGT is not payable on anything prior to April 2015. So hopefully that's a useful one. Julie, I know you have some questions on that as well.
I was just one more thing.
Sure.
Yeah, I looked at this some time ago and it was all about residence and domicile. And one thing that I realised is moving residence is one thing. Trying to move domicile is a damn sight harder if you were born in the
Domicility is very difficult because it's based pretty much on where your father's born.
That's right. Is there still the ability to just buy yourself a large boat and effectively be a nomad, and although you might own other properties, officially live on a boat that moves about?
Yes, well, actually, there's two answers to your question there. We've actually got one client who lives on a boat, and I'm trying to remember, and he did it for the very reasons that you're doing it. And the word isn't nomadic. Can you remember what the legislation is on that one, Mark? Because it's escaped me because we've only ever had one client. Mark Smith.
I can't remember what the specific legislation is, but it's to do with nomadic is the word. I'd have to look into that.
Okay. There is. If you live on a boat, then yes, there is a way to do this, Anthony. The other question is that you asked is, can you be nomadic? Well, you have to be resident unless you live on a boat, which is the one exception to the rule. Unless you live on a boat, you have to be tax resident somewhere, and that somewhere. The best place in Europe right now is Portugal, and that's why I'm non-resident there. And the reason for that is as long as you've got a home in Portugal that's available for your own occupation 365 days a year, there is no minimum time that you have to spend there. It's also the reason that I moved from my tax residency from Malta, because Malta's great, and I actually love Malta. Don't get me wrong, Malta has been my home for 4.5 years. But you have to be in Malta 184 days a year physically to be tax resident. And I didn't want to tell any lies and bend any rules. So by moving my tax residency to Portugal and acquiring a home there, then I can move around and I can spend 6 months a year in Florida, 10 weeks a year in Russia, and then a few weeks in England, and then the other 10 or 12 weeks I can spend either between Malta and Portugal, and that's perfectly acceptable to the Portuguese government. So if you're going to go nomadic, then Portugal is the obvious one to be in. Cyprus and Malta do have minimum stay rules to maintain your tax residency. So is that helpful, Anthony?
Well, I think what we probably need to do is have a one-to-one, Mark, and look at this properly. But yeah, that would be. I quite like Portugal. I used to go to a couple of racetracks there, and I quite enjoy it. One of the things I'm doing at my old age is racing cars again. Decided to do it before.
Very good.
Fiscal nomad is the phrase you're looking for.
What's fiscal nomad? Yes, I did hear that some time ago. But yeah, I think I need to do that. I've worked hard enough. I actually want to go out and enjoy a bit of it. So maybe. So. Where's the best way to contact you directly, Ewan?
You won't necessarily get me because it depends on availability. But I'm going to give you. So there's 5 consultants. I'm the head of the tax team, so they will always bounce things off of me anyway. And likewise, you will always end up speaking to Mark Smith. But if you look at your screen on the chat, I've just given you the link, property118.com/tax.
Oh, yeah, I've seen it. Right, okay.
Yep, and that's where you book and pay for a consultation. I'm not supposed to be doing any selling, so I'm going to get told off from Julie for answering that question. But at least
you get out of hand, I'll just mute you.
I still sell at my age. You're in business. It's a business.
Exactly. Thank you for your questions, Anthony. If you could just mute yourself down, we'll go back to Julie. Appreciate it and look forward to hearing from you, sir. Julie, have we...
We've had another question come in. I'm not sure what the question means. Susan Law, do you want to unmute yourself if you can and get your question across? Because I don't really understand what you mean. Sri Lanka or not covered? I don't know what the question means.
Yeah, hi. It was the same question as Dubai. The person before me is saying, does this Portuguese rule apply to Dubai as well as my question is Sri Lanka?
Right, I have no idea on Sri Lanka, I'm afraid. I'd have to look that one up separately. And Dubai, again, I'm not sure enough on my knowledge of Dubai. I've got several clients in Dubai and that work in Dubai, and they definitely qualify for the same CGT rules as Malta, Portugal, and Cyprus. But I don't know what the income tax rules are on those countries. I'm actually not allowed to advise you on any things on other countries, but in the same way as we do with whenever we do a tax consultation, we will provide a link to the authoritative source of information so that you can double check it for yourself. And we do that on every single piece of advice that we ever give, or guidance that we ever give. We'll always pull up the HMRC manual, or the legislation, or the official word of the government that we're talking about. So hopefully that's helpful, Susan. I'm sorry I can't answer your question on Sri Lankan tax law right now.
Brilliant, thank you. Has anybody else got any more questions to come through for Mark and Mark? No, everyone's gone quiet on me again. So that's all the questions that I've got for this evening. We've been through everything that I had that came through.
We've covered an awful lot. We've done really well, I think.
We have covered it. Is there anything else that you or Mark Smith want to go over this evening before we bring the meeting to a close?
Not from my side, no. We really wanted to have it led by the delegates rather than just telling people what we think they want to know. So I think we might do that as well as we could.
Absolutely. It's certainly been a brain tester for us, from the heart, not the chart, as we said. Putting us on the spot, putting you on the spot a bit, Julie, with some really good, well-prepared questions. So thank you for that. No, and thank you for having us. Hopefully people have found that useful.
Well, I hope so too. We've got some thanks coming through, so that's fantastic to see coming through on the messages. So the next event I've just been asked will actually be on the 2nd of June. I'm running them every fortnightly at the moment, so the next one will be the 2nd of June, and I will have Sean Hooker from the Property Redress Scheme. He'll be talking about the new mediation service that they've brought up for landlords. Obviously, in this particular time, I think mediation is ideal when you've got tenants that obviously can't afford their rent, and maybe communication might have been broken down a little bit. And I'll also have Cyril Thomas on from the Property Investors Bureau, and he'll be talking about property education and property educators. So I'm really interested to hear what he's got to say about that, because obviously earlier in the week there was another documentary on about Samuel Leeds, so I'm sure that's now fresh in everyone's minds again. So just reading the comments coming through, thanks guys for attending this evening. I couldn't do it without you, otherwise it would just be me and M&M sitting here. So thank you so much. And if you've got any further questions for Mark Alexander or Mark Smith once we close the webinar, please just ping them through to me. You've got emails that have come through to you, and I'll get it over to the guys straight away so they can contact you directly. All right. So I'm going to bring
you. Good night, everybody.
Thank you so much, Mark Smith, Mark Alexander. Been a pleasure. Thank you so much.
Thanks. Good night.
Bye.